Let me ask you a question. What happens when an entire society builds its retirement system around the assumption that people die on schedule? Because that sounds dramatic, but it is basically the business model. Work for 40 years, save some money, maybe get a pension if you were born in the correct century, collect government benefits, move somewhere warm, complain about property taxes, watch daytime television, then politely exit the spreadsheet before the math gets too uncomfortable. That was the plan. And for a while, it kind of worked. But now something very awkward is happening. People are living longer, having fewer kids, saving less money, and expecting retirement to last 25 to 35 years, which is insane when you remember that the original retirement system was designed in an era where making it to retirement age was basically the final boss fight. And nobody wants to talk about this because retirement is one of those comforting ideas we treat like a national bedtime story. You work hard, you save, the system takes care of you. Cute, adorable. Financially, it's starting to look like a group project where the youngest person in the room does all the work and everyone else keeps asking why the vibes are off. Because here's the thing, retirement is not money sitting in a magical government vault with your name on it. It is not a dragon's treasure pile guarded by responsible accountants in gray suits. Most retirement systems are built on promises. Promises that future workers will pay future taxes, future markets will deliver future returns, future politicians will make future responsible decisions, and future inflation will not eat everyone's savings like a raccoon inside a Chipotle dumpster. That is a lot of future. And finance has a word for promises that depend on everything going right forever. A problem. Now, to understand why this is getting dangerous, we need to go back to the beginning. In the old world, retirement was not really a thing for normal people. You worked until your body gave out, then your family took care of you, or you became a cautionary tale with arthritis. Then the 20th century came along, and government started building public retirement systems. The logic was simple. Younger workers pay into the system, older retirees receive benefits, and because there were lots of workers and fewer retirees, the math looked beautiful. Beautiful in the same way a gym membership looks beautiful in January. The problem is that the old model depended on three things: a growing population, a shorter retirement period, and a large working class supporting a smaller retired class. And all three of those assumptions are now getting punched in the face. Let's start with demographics, because demographics are basically financial destiny wearing boring clothes. In 1960, many developed countries had birth rates above replacement level. Families were bigger, workforces were younger, and retirees were a smaller share of the population. Today, birth rates across much of the developed world have collapsed below the replacement rate of about 2.1 children per woman. Japan is below that. South Korea is way below that. Much of Europe is below that. The United States is below that, which means the retirement system is quietly turning into an upside-down pyramid. More people collecting, fewer people paying. And the people paying are already getting financially waterboarded by rent, student loans, healthcare costs, childcare costs, and grocery bills that make you wonder if eggs have started trading on the NASDAQ. This is where the math starts to get ugly. A pay-as-you-go retirement system works great when you have 5 workers supporting one retiree. It works okay when you have 3 workers supporting one retiree. It starts looking sweaty when you have 2 workers supporting one retiree. And it becomes a financial horror movie when you realize those 2 workers are both named Tyler. They rent a 1-bedroom apartment for $2,700 a month, and one of them thinks buying fractional shares of Tesla is a retirement plan. This is not normal, and it is not just a government problem. Private pensions have their own little carnival of delusion. For decades, companies and governments promised workers guaranteed retirement income. And to be fair, that sounds amazing. Work here for 30 years, and we'll pay you for the rest of your life. The issue is that pensions are only as strong as the money backing them, and many pensions assumed investment returns of 7%, 8%, sometimes even higher, which is great if markets cooperate. But when markets don't cooperate, those promised returns become less of a forecast and more of a vision board. And this is the part nobody likes to say out loud. A pension promise is not automatically money. It is a liability. It is a bill. And if the assets are not there when the bill comes due, someone has to pay. That someone is usually taxpayers, younger workers, future employees, or nobody, which is finance language for good luck, grandma. Now, before someone gets mad, this does not mean every pension is doomed. Some are well funded, some are managed responsibly, some have made painful adjustments, but the system as a whole has a very obvious weakness. It promises certainty in a world that does not offer certainty. That is the same mistake investors make during every bubble. They take something that worked before and assume it must work forever. Housing only goes up. Tech stocks always win. Crypto is the future. Retirement will be fine. Same bedtime story, different pajamas, which brings us to personal retirement accounts. Because when pensions became too expensive, companies basically said, you know what would be fun? What if we made normal people responsible for managing their own retirement portfolios? And just like that, the risk was transferred from institutions to individuals. Congratulations, Karen from HR. You are now your own pension fund manager. Here is a menu of 37 funds with names like Growth Opportunity Plus Strategic Advantage Fund Class C. Good luck. This shift created the modern retirement account culture. 401ks, IRAs, index funds, target date funds, auto-enrollment, employer matches. And honestly, some of this is good, very good. And if you start early, invest consistently, keep fees low, and avoid doing something emotionally catastrophic every time the market drops 12%, you can build real wealth. But that sentence has a lot of ifs. And humans are not exactly famous for calm, long-term decision-making. These are the same creatures who panic sell during crashes, buy tops during bubbles, and click accept cookies on every website like they're signing peace treaties. So the retirement system now depends on millions of people making disciplined investment decisions for 40 years straight. Let that sink in. The same population that made meme stocks a personality trait is now expected to quietly compound wealth through diversified asset allocation. This is why the retirement gap exists, because the people who most need retirement savings often have the least money left to save. And the people who have money to save usually already own assets, get employer matches, benefit from tax advantages, and understand compound interest before it ruins everyone else's life. In other words, the retirement system rewards the people who can afford to use it, which is kind of like giving a discount on groceries to people who already own the supermarket. But it gets worse, because even if you do save properly, retirement itself is becoming more expensive. Healthcare costs rise faster than normal inflation. Housing is expensive. Insurance is expensive. Long-term care can wipe out savings with the efficiency of a divorce lawyer in a yacht club. And inflation does not need to be dramatic to be destructive. A 3% annual inflation rate cuts purchasing power roughly in half over about 24 years. That means if you retire at 65 and live into your late 80s, your money has to survive not just markets, but time itself. And time is undefeated. This is where the classic retirement advice starts to sound a little suspicious. Just withdraw 4% per year. The famous 4% rule came from historical market data and was meant as a guideline, not a religious text. But people treat it like Moses brought it down from Mount Vanguard. The problem is that your retirement outcome depends heavily on the first decade after you retire. If markets do well early, you look like a genius. If markets crash early, your portfolio can get permanently damaged because you are withdrawing money while the account is down. This is called sequence of returns risk. Or in normal English, bad timing can punch your retirement in the throat. Imagine two retirees with the exact same amount of money, the exact same average return, and the exact same withdrawal rate. One gets strong market returns early. The other gets a crash early. The first person travels Europe. The second person starts comparing canned soup prices with the intensity of a hedge fund analyst. Same plan, different order, totally different outcome. That is retirement risk. It is not just how much you have, it is when things go wrong. And things will go wrong. Markets crash, inflation spikes, healthcare surprises happen, adult children move back home, roofs start leaking, governments change rules, life shows up and starts charging fees. This is why the retirement fantasy is so dangerous. The fantasy says retirement is a finish line. The reality is, retirement is a 30-year financial obstacle course where the obstacles are invisible until they hit you. And here's the uncomfortable truth. Nobody actually knows what retirement will look like for younger generations. Not really. Maybe markets keep delivering strong, long-term returns and everything works out. Maybe AI boosts productivity, wages rise, and retirement gets easier. Maybe governments reform benefits slowly and avoid a crisis. That is the optimistic case, but the darker case is that benefits get cut, retirement ages rise, taxes increase, inflation stays annoying, and people work longer because retirement becomes less of a phase of life and more of a subscription service they cannot afford. And the most likely outcome is probably the messy middle. Not collapse, not paradise, just a slow, quiet downgrade. People retiring later, saving more aggressively, living with less certainty, depending more on family, working part-time in retirement, and pretending this was always the plan. Because systems rarely explode all at once. They usually get worse slowly enough that everyone adjusts and calls it normal. That is how you end up with 70-year-olds working retail and politicians calling it flexibility. That is how you end up with young workers paying into systems they are not fully confident will exist in the same form when they need them. That is how you end up with a society where retirement stops being a standard life stage and becomes a luxury product. And that is the real problem. Retirement was supposed to be the reward for decades of work, but increasingly it is becoming a math test. Did you save early enough? Did you invest correctly? Did you avoid major mistakes? Did you buy a house before prices went insane? Did you stay healthy? Did your employer offer a match? Did you avoid retiring into a crash? Did your government keep its promises? Did inflation behave? Did you have kids? Did your kids need money? Did life leave you alone long enough to compound? That is not a retirement system. That is a financial escape room. And most people were never given the instructions. So what does this mean for you? First, do not assume the system will save you. Maybe it helps, maybe it doesn't. But building your entire future around political promises is not a plan. It is pre-ordering hope. Second, understand that time matters more than genius. You do not need to be the next Warren Buffett. You need to avoid being Dave with options, approval, and a dream. Third, fees matter. A 1% fee sounds tiny until you realize it can steal a shocking amount of wealth over 30 or 40 years. Wall Street loves small percentages because small percentages on large balances are how boring people buy beach houses. Fourth, inflation is the villain nobody respects until it wins. Your number is not your number unless it is adjusted for purchasing power. And fifth, retirement is not just an investment problem. It is an income problem, a housing problem, a healthcare problem, a tax problem, and a behavior problem, all dressed up in a nice brochure with an elderly couple smiling on a sailboat. So no, the retirement system is probably not going to vanish tomorrow. There will be no dramatic movie scene where someone runs into the office yelling, "The pensions are gone." It will be quieter than that. Benefits will stretch thinner. Workers will work longer. Asset owners will be fine. Non-asset owners will struggle. And everyone will slowly realize that the old deal changed while they were busy trying to survive the new economy. That is the part that feels off, not that retirement is impossible, but that retirement has quietly become something you have to personally engineer with the precision of a NASA launch, while the world keeps handing you grocery inflation, rent hikes, medical bills, and investment choices named like prescription drugs. So here's the question. Do you think retirement is still realistic for most people, Or are we watching it become a luxury for people who already own assets? Drop your take in the comments, because I genuinely want to know where people land. Are we looking at a system that adapts and survives, B, a slow motion retirement crisis, or C, everyone working until 73 while pretending it's empowering? Either way, one thing is clear. The old retirement story is breaking, and the math is starting to notice. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.